So in this chapter, we are going to learn about ACCA 600, which specifically talks about special consideration with respect to audit of group financial statement. So ACCA 600 is special considerations of audit of group financial statement. Audits of group financial statements. So this particular standard of ACCA 600 applies when an auditor uses the work of another auditor on the financial statement of one or more components included in the financial statement being reported on. So it is specifically for or applies for when an auditor using the work of another auditor on financial information of one or more components included in the financial statement. So of another auditor of financial information of one or more components within the group. Okay, now in this sentence, if you read it, there are few questions that might come to you. What is auditor using the work of another auditor mean? What does components mean within the group mean? So to understand this in detail, let's go through the basic terminologies of what is a group audit and what is a group auditor, what are a component auditor, what is a component, etc. So firstly, what is group? We have learned this in financial reporting and as well as strategic business reporting, SBR, that a group is a reporting entity for which group financial statements are prepared. This can include legal or other entities such as parents, subsidiaries, joint ventures and associates, as well as business units, functions, activities, branches or division. So group is where there will be one single entity. Let's call it as ABC Corp. Okay. This will be one single entity. Within this entity, there will be multiple divisions and multiple entities which are reporting to them. So there could be another entity called as XYZ, which could be a subsidiary. Then there could be another entity which is called as AB, which is a branch, which could be a branch. Then there could be another entity which is called as PQ, which could be an associate entity. Then the same AB, which is running as a branch, could be having a joint venture with another entity called as RS group. Let's say, for example, let us say this branch is in India and they have created a branch. ABC have created a branch in India and they have joint venture with RS group and doing a business together. A simple example is Hero Honda, where when Hero came into here, they created a Hero's branch from the Japan. They created a Honda branch, and they joint ventured with Hero company motorcycles and they jointly built motorcycles together. So it's a joint venture. So likewise, all of this categorized together, every company combined together, all of this combined together, they will be called as a group. And each of the entity is a separate legal entity. Okay, each one of them are separate legal entity. What does the term separate legal entity mean? It's a basic of accounting terminology. That separate legal entity is an entity which is separate that of its owners and parents. It is a standalone entity which has its own reporting requirements. So each entity, which is a separate legal entity, will have its own financial statements which are prepared for. So XYZ will have its own financial statements, AB branch will have its own financial statements, associate entity will have its own financial statement. And these company together, which all these three together, will be added or will be included in the financial statement of ABC Group. So the financial statement of ABC Group will include XYZ's financial statement plus AB's financial statement, which are subsidiary and branch, and a portion of ownership, depending upon ownership, percentage of ownership of the associate entity. So the accountings are different. So in XYZ subsidiary, it's a full based consolidation. So it will be equity method of accounting. Sorry, it's a consolidated basis of accounting. AB branch will be again a consolidated. The entire financial statements of AB branch will be consolidated. Associate entity will be followed an equity method of accounting. The profit or loss will be added to the profit or loss of the company. Like that they will follow. So this entire companies are called as a group. Group financial statement, which would include the financial information of more than one entity, as I told you, which would include the financial information of XYZ branch and PQ, are called as group financial statements. And consolidation is a process as per IFRS 3 business combination is a process of combining the financial statements of entity or business units such as branches or division under common control via some form of aggregation, including full or partial consolidation and equity accounting. So here, as I told you, the financial statements of in full consolidation, what will happen is that assets of XYZ plus assets of AB will be added to the assets of ABC, and that will be called as group assets of ABC Corp. Right. Similarly to this, there will be liability of XYZ, liability of AB and liability of ABC will be added together to called as group liabilities. Right. So similar to this, liabilities of XYZ plus liabilities of AB plus liabilities of ABC, which is the parent entity, will be added together to called as group liabilities. Group liabilities ABC. Then in terms of equity of the subsidiary will not be included. Equity of the branch will also not be included because that will get cancelled against each other, and equity of ABC will be included to call as group equity. To that you will include, to the equity you will also include other aspects which are like retained earnings. Other aspects like retained earnings of subsidiary, plus you will include the non-controlling interest NCI. Then you will include the non-controlling interest NCI, etc., which will happen in ABC company. And in assets you will also include the investment in associate along with the retained earnings of associate, which will be added to the ABC group assets. So doing this process is called as consolidation. Taking up the financial information of the subcomponents and adding together is called as consolidation as a process. Group management is the management who is responsible for preparing the group financial statement. So whoever is managing this particular company will be called as group management, who will be responsible to prepare the financial statement of the group entities will be called as group management. And group audit is the audit of the group as a whole, like all the elements or all the subsidiaries, associates, everything we need to check is called as a group audit. So when we are doing the audit of this entire consolidated financial statements of ABC Corp, that is called as group audit. So audit of consolidated financial statements of group are called as group audit. That will be called as a group audit. Whoever who's doing the audit of the group financial statement are called as the group auditor. So whoever is doing this group audit, he will be called as group auditor. Whoever is performing this group audit will be called as the group auditor. The concerned person will be called as the group auditor. Then there will be group engagement partner, the engagement partner who is responsible for the group audit. So whoever is the engagement partner of the group auditor who is responsible for the audit is called as the group engagement partner. Okay, who will be called as a group engagement partner. And the group engagement partner, as per ISA 220, is the responsible for managing the quality of the engagement, including the audit of any components undertaken by either the group auditor or a component auditor. So you have understood the term group. I hope you have understood the term group. So all elements or all the components of the group, like individual standalone entities within the group, added together are consolidated financial statement. Whoever audits the consolidated financial statement of the group are called as a group auditor. And whoever is the responsible partner within the group auditor is called as the group engagement partner. So who is the component auditor? Who is the component and who is the component auditor? Who is the component? So these people, like subsidiary, branch and associate, these three people, 1, 2 and 3, subsidiary, branch and associate, they are the components. They are called as the components. And who is a component auditor then? As I told you, these components are separate legal entities by themselves. Like they have their own reporting requirements. Because subsidiary XYZ could be situated in America, ABC Corp could be situated in London. So a company which is situated in America, they have to follow the regulations of American soil, right? They will have to report to the SEC of America, do this, do that, etc. Right? So each time a company creates a new company, organization, they have to follow the reporting requirements for that company. Give an example, take a case of Reliance. Reliance have how many companies in them? Jio has how many companies? You have this entertainment services, financial services, lot of companies. For each time they're creating a business, they will create a new company, and that company will be registered and will be going for the public limited company. And that company have to go and do reporting requirements for those company. They have to file taxes in the name of the company, like that. So component are like a child, and the child of the parent will grow, and they have to take care of their own things. They have to study, they have to work, find jobs, etc. Similarly, entities are created by the group, or entities are purchased by the group, and then the entity which are working, they have their own standalone requirement. They have to file for their taxes, they have to prepare their own financial statements and present it to their shareholders. One shareholder will be group, etc. Just because my financial statement is being consolidated into the group, I don't have to prepare a financial statement and I don't need an audit is not necessary. Your group might be situated in America, but the subsidiary might be in India. Who will take care of the Indian regulations? Right. So likewise, every entity which is part of the group will have to follow the necessary, reporting requirements. Take a case of Tata Group. Tata has so many companies within them. The parent company, Ultimate Tata Holding Company, will just hold these investments. All other separate entities will create their own separate financial statements and do the reporting requirements. So because they are all separate legal entities. As per the law is concerned, they are separate. For accounting requirement, you can consolidate it and put it as it's all your part of your subsidiary and your parent is there. That's fine. But child also have to separately report. Parent also will have to separately report their financial statement. So when parent is reporting, they can include all their children. But when child should report, they should report only about themselves. Right? That's called as a component and the group auditor. So whoever audits these components are called as component auditor. Component auditor. Whoever audits the separate standalone financial statements of these branches, divisions, subsidiaries, etc. are called as component auditor. Okay. So just to help you with the the structure, I'll walk you through a simple illustration of a group and some of the terms which are used. Let's say, for example, there is a group company called as MCO, which is having a year end of 31st December 2007. Here the auditor is SAN and company. So MCO will be the parent and SANCO will be the group auditor, and the SANCO has the sole responsibility for forming the audit opinion of the group financial statements. The group financial statement will consist of T company subsidiary, which is having a year end of 31st December, V company subsidiary, which is 75% subsidiary, having a year end of 30th September 2009, but it has to be prorated or it has to be converted to the year end of 31st December 2007. Why? Because the group's reporting deadline will be as of the parent, which is 31st December X7 itself. Similarly, there is GmbH, which is the year end of 31st December X7. That's not the problem, but the problem is it is in Germany. It is in Germany. So here each of the subsidiary has its own problems. For T company, which is a subsidiary, this should be straightforward. Why? Because this should be straightforward because SAN company are the parent as well as the group, as well as the component auditor. So SAN company is the component auditor and it should be straightforward because it's internal to the company, it's easier. But V company, it's a different auditor called as Mont and Company. There is Mont and Company. So here there are three issues. One is that it is non-continuous year end. So there will be 3 months of gap between the parent and the subsidiary. So if there are significant events in the interim time, if there are no significant events, it's fine. Otherwise, we need to have an interim FS as well, which we need to review. Second, the component auditor, SAN company, evaluates Mont company and decides to the extent they will rely on their work. Because it's another entity. So whether Mont company is actually capable or competent enough to do the work of assigned by SAN company or not, they need to evaluate. And based on that, Mont company will, SAN company will discuss with Mont company. Second, it's a 75% ownership. But it's not a problem as long as the component is accounted correctly as a subsidiary. So even though it's 75%, it is a subsidiary because there is control. Then the third one is, if you look at here, the year end is not a problem, but the problem here is definitely two different entities. So two different auditors. So the auditor is Pismo, which is based in Germany and having separate individual responsibility for forming opinion on V company of XMBH company, and Pismo is a totally different auditor. So, and they are in separate jurisdiction, so that could be a problem. And there will be foreign currency translation adjustment, so that could also be a bit of problem, and cooperation of Pismo company by the SAN company as an auditor will be a problem. So if you look at here, without going through identifying certain additional risk of inherent risk or controlled risk with respect to the scenario of group, we can easily identify the risk which we might face during the audit, which is having a component auditor itself is a part of a risk. There could be issues. Foreign currency, different component auditor, there would be communication issues, or there could be issues relating to the foreign currency transactions. If the year end of the subsidiary is different to the parent, then for the difference of period, we need an interim financial statements of the subsidiary. That also needs to be taken into consideration. So let's understand this ISA 600 in a bit detail, and what are the responsibilities of an or objectives of an auditor, and what could go wrong when it comes to the audits of group financial statements. So the ISA 600, which is the revised one, which has been very recently revised, reflects the recent changes to the auditor's approach. Like, what should be the auditor's approach in respect of quality management, risk assessment, and audit documentation that you have already learned about. So auditing a group financial statement is nothing majorly different compared to normal financial statement. You will do all the procedures that you're supposed to do. Only thing that there are special consideration you need to give. Like, additionally, with the group's financial statement, there are component as well, which also will affect the group's financial statement numbers. So you have to be careful about that, and you might have to work with another component auditor who is auditing the component, and come to a conclusion together whether the component is material, not material, whether the component is the date numbers in the component is materially misstated or not. So those things. So when it comes to ISA 600, the documentation part, the risk assessment part, the quality management part stays the same, but few important reiterations have been given with respect to this professional judgment and professional skepticism that needs to be displayed by the group engagement auditor. Why? Because when it comes to group audit, definitely it's a complex compared to normal audit. It's a complex one. Why? Because there are, as I told you, there is a parent entity, there are subsidiaries. Subsidiaries numbers are also getting added to the parents numbers. Subsidiaries financial statements gets added to the parents financial statement. So if subsidiary is making a loss, the parents' profits will reduce, which will lead to materiality will further go down. So you need to understand those things which could affect the companies. So like transaction that could affect the financial statement, components could affect the financial statement. So ISA 600 specifically talks about certain things that could affect the professional judgment and skepticism of the group auditors, which are: number one, any unconscious biasness. Like that might caused by cultural differences in foreign components that could occur when designing and performing audit procedures or evidences. So there could be situations where, like the way that you as an auditor are functioning versus the way the group auditors are functioning, there could be some cultural differences which could lead to certain biasness, and that biasness might happen not because of a conscious nature, but unconsciously you might be biased. Okay, this to give you an example, Japanese don't lie. It's an unconscious bias. You are taking a stand that okay, these people don't lie, so definitely what they are reported is appropriate. Second is complex of the organization structure. So you might unable to identify risk of material misstatement due to the complexity of the organization structure. There are intra-group transactions. So groups could sell within the group itself, which could lead to cancellation, and it could lead to make the transaction a much more complex one and make it challenging to identify the fraud risk, etc. Because they are doing intra-group trading, and intra-group trading definitely will affect something called as transfer pricing. Related party transactions, which we learned in the previous chapter. So related party transactions could occur, which could lead to further complexity, and whether there is fraud or no fraud, whether the related party disclosures are correct, all those things could lead to a bit of complexity for the auditor. Reporting deadlines could be very tight, which will put pressure on the auditor to complete the work on time with the same quality, which could increase the audit risk. And finally, alert to the inconsistent information. So as I told you, as a group auditor, he has to work with a component auditor. He might be required to work with a component auditor. and the group auditor might not have the component auditor might not have the same level of competence and capability that of the group auditor. So if the component auditor is is giving inconsistent information, definitely it could affect the group auditor's work. What if the component auditor has some material misstatement, but the component auditor just waved it off? So those are inconsistent and immaterial material things which we need to be careful about. So you need to understand that this particular ISA 600 would affect the scalability of the audit, which means the transactions which are occurring to the component are scalable to the context of the engagement, right? So this particular ISA have focused on the scalability, and they have laid down the objectives of the auditor. Now, in ISA 600, the first step is to accept as the objective of the auditor. The first step is to accept and continuance the group engagement. So firstly, determine whether you want to accept or continue a group audit engagement. Why it is the first step? Because if I don't have the competence, do not accept the engagement. Staying away from an engagement is definitely reducing a risk. Take an example of Adani Group case. Adani Group EY is being audited now. NFRA have have put up an investigation notice on the audits of EY of the Adani Group. So if EY had not taken up the work of the Adani Group, definitely they would not have gone to this investigation part. So sometimes if you're not competent enough, if you don't have the capability, if you don't have the resources, it's better to avoid accepting a group audit engagement, because they are complex in nature, and if you don't have the resources or competence or capability, it would affect your professional judgment, which thereby leading to making mistakes, thereby leading to penalties and cancelling of your license altogether. The next one is if the auditor is engaged to perform the group audit, then identify and assess the risk of material misstatement at a group level for the entire group financial statements. Group financial statement, which would include the component as well. Sufficiently and appropriately involve the work of the component auditors. Involve the component auditors. Communicate clearly with a component auditor about the scope, timing, etc. of their work, and evaluate the results of their work as well. So you need to communicate the scope, timing of their work, and as well as evaluate the results of their work. Third one, evaluate whether sufficient appropriate evidence have been obtained from the audit procedures performed with respect to the work performed by the component auditor on basis of forming an opinion. So while you are going to form an opinion on the group audit, you need to evaluate whether sufficient appropriate evidence have been obtained or not. If you have obtained sufficient appropriate evidence, you need to not just obtain the evidence for the group financial statement, but also based on the work performed by the component auditors. So based on your work as a group auditor, whatever work evidence you have obtained, you need to reach out to the component auditors, get their work done, check their work, review their work, and form an opinion by checking their work as well. That's what the objectives of ISA 600 lays down. So it's very important that you lay down what are the objectives of an auditor who was auditing a group entity. So as laid down in the quality management standards, the overall responsibility for quality with respect to the group audits will be for the group engagement partner. He needs to ensure that the group audit is functioning in a smooth manner, taking into consideration all the necessary work that is done, and he needs to take care of the quality, responsibility, and overall completion of the audit. So he will be the primary responsibility for the entire group audit. He needs to be actively involved with the group audit, and he will be the one who will decide who performs the work on the group audit. The management of the quality may require cultural and even practical solutions to be adopted. For example, if there are large number of component auditors to be managed simultaneously across multiple locations, some degree of delegation may be inevitable. So Even though he is the one who is having primary responsibility, he can decide to delegate the work. There could be instances where there will be multiple locations for a same company, and he might delegate his partners, his junior partners, according to the same locations for the audit to be completed. And even for when there is a component auditor, the component auditor will also have the partner, manager, staff, etc., who will do the work of the component auditor. Group will have the entire group management part, etc. Entire group audit will be the management part, etc. He has to take care of the group audit resources, deadlines, materiality, and he needs to take care of the involvement of the component auditor, etc. Also, the group auditor will manage the detection risk presented by the component auditor via two-way communication between the group and the component auditor to decide the extent of the direction, supervision, and review of the component auditor's work. So, how far the component auditor's work will be reviewed, how much he has to work, what will be his work, everything will be decided by the group auditor. And it will be based upon a two-way communication. The group auditor will not work isolated. He will work along with the component auditor, and they will have a two-way communication to decide the direction, supervision, review, and extent of work that has to be performed by the component auditor. In terms of the acceptance and continuance, just like any other engagement, the group engagement partner determines whether or not the group auditor is able to obtain sufficient appropriate evidence to form an opinion on the group financial statements. So, like in any other audit, the audit partner is the one who decides whether he has whether he is able to obtain sufficient appropriate evidence or not to form an opinion. So similarly, in group audit, it is the group auditor who will decide the decision based on to obtain sufficient appropriate evidence to form an opinion. Now, in this case, the revised ESA provides more details. Of the sources of information that may be used by the group engagement partner when deciding the availability of sufficient audit evidences. So the below will need to be detailedly understood by the auditor before he takes up a call. Firstly, he needs to go through the group structure. What are the activities performed by the group? Other relevant factors such as the complexity of the group, legal structure of the group, what are the regulatory requirements of the group, etc. The use of support services and other organizations by the group. Support services are also called as shared services. Now, what are shared services? Let me give you an example. What are shared services? So, in terms of shared services, okay, I'm going to give you a practical example, a live example. Okay. I don't know if you have heard the company called as JP Morgan. Okay. So JP Morgan is a bank which is based in US. Okay. And it has an head office in US. So JP Morgan, does all the banking transactions, right? They also might have an IT division because they need a lot of IT systems and safety and securities, etc. They also need, they are banking, so they need a KYC team, operations team who will do the backend operations, etc. Who will onboard the clients, lot of other data. So to facilitate all this, JP Morgan would be like, okay, you know what? All those work which need not be done in a head office, because US, of course, it's a costly place to get up with people to work on a daily basis. It's difficult. What they will do? They will create a shared workspace, a shared space, a shared office, or a shared services. Now, what is a shared services? Shared services will be a separate entity or a subsidiary of a JP Morgan. So JP Morgan had a shared services called as JP Morgan Services Private Limited. Okay. This Services Private Limited was located, of course, in India. There are other countries as well. These are located. But India was chosen the first one. Why? Because cheap labor, quality labor, reduced cost of labor, reduced cost of the infrastructure with a better services, etc. India was a primary marketplace. So hence they created a company called as JP Morgan Services India Private Limited. Now what will they do? JP Morgan India Private Limited, they will hire people. There will be around, I would say, I'm giving you a random number, around 1,000 people who are sitting in JP Morgan India Private Limited inside that particular company. But they don't work for JP Morgan Services India Private Limited. Do you know who they work for? They work for various other entities of JP Morgan. There was JP Morgan, broking company, brokerage in UK. There was, JP Morgan Securities. Like that, multiple entities were there. There were more than 100 entities. So these 1,000 people, what do? They work for all these entities across the globe. They work for the head office also. Only thing is that they are situated in a separate country altogether. Okay, now the Services Private Limited, what do? All they do is they give seating arrangements for these people, host these people, and get paid for them. How do they get paid for them? So JP Morgan Services India Private Limited hosts these people. So which means these 1,000 people are under the human resource of JP Morgan Services India. So they are under the human resource of JP Morgan Services India. The salaries are paid by JP Morgan, Services India Private Limited. All the salaries of these 1,000 people are paid by this company. So where will they get this money from for the salaries? They will get it reimbursed. From all these companies. So JP Morgan Services was a shared space. JP Morgan Services was a shared services which hosts all these employees, which will support the front office. Okay, which will support the front office. Okay, in return the front office will pay, or I would say pay or repay for the services provided. Provide service. So JP Morgan will provide service to the front office. They will support or provide service to the front office, and these front offices in return, JP Morgan front offices, and these front offices, what they will do? They will pay for the services that is offered. So for JP Morgan, what will be the biggest revenue? JP Morgan Services India, if you look at their statement of profit or loss, their biggest revenue will be from all these transfer pricing services from front office. So whatever payment they get from their transfer pricing services which they have offered, okay, that's what they will get their revenue from. What will be their cost of sales? Cost of sales will be their salaries paid, expenses, salaries, etc. Minus what will be their gross profit? Will be the percentage of profit that they have fixed for the services that they render. So if I render a service, I have a certain expense, right? My salary has to be borne. I will take care of what is my salary, what is my expense to sit up in front of a computer and work, what is the rental for a seat, etc. So likewise, JP Morgan Services India Private Limited, housing 1,000 employees, they will have to pay salaries for these 1,000 employees. They will have to take care of the seating of these 1,000 employees. They have to give them laptops for these 1,000 employees, give them food, give them water, give them electricity. All these expenses will be included in their cost of sales. Plus, all these expenses added together, they will create a bill. And that bill will be presented to the JP Morgan front office, which will pay for the services offered by these people. So that will be the revenue. And this is the concept of shared services. Every company, majority of the company, IT company or MNC companies now uses shared services as a concept. Even manufacturing companies have shared services as a concept. So hence it's very important. Hence it's very important to know this particular concept, because as a group auditor, you might be called to audit a shared services entity. So you need to know what is a shared or a support services entity. Shared or support services entity are entities which support the front office, so that it's like an outsourcing itself, but outsourced within the entity, created a specific entity outside the country's headquarters of the jurisdiction, so that they can reduce the cost and support easily. So coming back to the acceptance and continuance, the engagement partner should look at the group structure, the legal structure, whether they are using service entities, because then service entities is a big audit. Because auditing of the service entity, there will be so many people, there will be so many transactions. All of those have to be audited, which lead to a complexity. Consolidation process used by the group. How are they consolidating it? When do they consolidate? What time do they consolidate? Are they monthly, quarterly, yearly? How are the transactions consolidated? Is it manually or do they have a system, etc.? Do we have access to information management and those charged with governance throughout the group and its components? Are we all aligned, and do I have enough information for all the group? For initial audits, the availability of information from management will be a crucial part of the acceptance decision, because we need to check whether the information is available, etc. For recurring engagements, there may be additional factors become relevant. So if you are doing the first audit of the for the first time of this group company, then you will follow the ones which I have already mentioned. For recurring audits, recurring means continuous. Every year or every month, you might do certain audits. For that, additional consideration should also be taken into picture. These include changes to group structure, component significant, composition, display of integrity and competence, applicable financial reporting framework, social, economic and cultural and other factors. So in this, what we are doing is recurring is, so initially when you do the audit, you look at all the initial audit procedures before you accept a client, and what are the things that you need to take into consideration, the group structure, whether you have communication, availability of information from management, all of those things. The next year when you audit, so once you audit for the first time, that's an initial audit. Next year it's a recurring, like last year also you audited, this year also you are auditing. In that case, you need to check, it's a new year now, correct? It's a new year altogether. When there is a new year, in the past 12 months, there would have been changes to the group. Like a company would have purchased a subsidiary, or they would have sold a subsidiary. They could have introduced a new branch. They could have bought a new associate. They could have sold an associate. A lot of things could have happened. So we need to check what are the changes to the group structure. What are the changes to the component significance, like whether significant changes have happened to the component. Existing components, which are subsidiaries, have they changed? Are they subsidiaries or are they associates? Have we sold the investment, etc.? Composition of management and those charged with governance throughout the group and its components. Last year, how did they contribute to the communication, and still now do we have communication with them? Integrity and competence of the group or the component management. The management of the component and the groups, what was their integrity? Last year, how did they, when we did the audit, did we have questions on integrity of them? Because 1 year now we are experienced, or a couple of years we are experienced. So we will add those parameters as well before we want to continue with the client, or before we accept the client for another 1 more year. Whether last year did we face any problems with them? Did we identify certain factors which questions their integrity? Are there changes to their financial reporting framework? Have they changed something or not? What are the changes to the social, economic, cultural factors, etc., such as outbreak of a war or disease? It's a very good example which have been very recently introduced after 2 situations. One is the COVID-19. Second is the Russian war. After the outbreak of a Russian war, you know what happened? Many companies pulled out of themselves from the auditing the Russian companies. EY specifically, when I was working there, we got email when the Russian war broke out. They said that they are exiting all the relationships with the entities they are auditing in Russia. JP Morgan exited their one of their major companies in Russia, and they situated it somewhere else. So when such social factors changes, then as an auditor, they might also change. Their decision might also change. So we need to consider last year, what was it? And in current year, have there been any changes? And because of these changes, do I need to change the audit? Do I need to accept this particular client or not? Is something the engagement partner need to consider. Because as I told you, the moment you accept a client, you are exposed to a risk, audit risk. So if there are factors which have changed for the particular audit compared to the last year, then the question is whether you want to continue with the client. Okay, the group structure changed, so now it's high risky. I don't want to continue. The management have questions of integrity. I don't want to continue. I don't want to risk my part. So those kind of things will have to be considered by the partner.